Hey there, welcome to the NASDUCK Weekly Podcast. I'm Rick Sullivan. Now, some of you are probably new here since it's our debut on YouTube. Here's hoping some of you have a look at my Substack after listening to this. But that's enough chatter. Let me tell you something straight up. I spent 20 years on Wall Street watching the machine chew up regular folks and spit them out. Now I'm on the outside, and I'm going to tell you exactly how this game really works. Today we're talking about dividend investing, and boy do I have some stories for you. But first, let me set the stage here because the timing couldn't be more critical. The Shiller PE ratio just hit 37.6, and for those of you who don't know what that means, it's basically a measure of how expensive stocks are compared to their actual earnings power over the past decade. The historical average sits at about 16, so we're sitting at more than double what markets normally trade for. You know what that reminds me of? It reminds me of 1999, right before the dot-com crash, and 2007, right before the financial crisis. But here's the thing, the suits on Wall Street, they're not going to tell you this. They're going to keep selling you the dream because that's how they make their money. They get paid whether you win or lose. Now, I want to talk about dividend investing because it's one of those strategies that sounds so sensible, so safe, so American. You buy stocks that pay you dividends. You live off that income. You sleep well at night. The financial media loves this story. Your broker loves this story. But let me tell you what they don't want you to know. Most people who think they're dividend investors are actually just gambling addicts in disguise. They see a stock yielding 8, 9, 10% and they think they've found free money. I've seen this movie 1,000 times. AT&T was yielding over 7% before they slashed their dividend in 2022. General Electric was a dividend darling until it wasn't. These companies were handing out cash they didn't have, borrowing money to pay dividends, basically running a legal Ponzi scheme. And you know why this happens? Because our entire economic system is built on quarterly thinking. CEOs get bonuses based on this quarter's numbers. Fund managers get judged on this year's performance. Nobody gives a damn about building something sustainable for the long term. It's all about extracting as much value as possible, as quickly as possible, consequences be damned. I remember sitting in boardrooms where we'd discuss dividend policy, and it was never about what the company could afford. It was about what would keep the stock price up until the next earnings call. We'd literally rob Peter to pay Paul, cutting research and development, laying off workers, selling assets, anything to keep that dividend check flowing to shareholders. And the analysts would applaud us for it. But here's what really pisses me off. They've convinced regular people that this is how wealth building works. That you should hand over your life savings to companies that are more interested in financial engineering than actually making things or solving problems. Meanwhile, the real wealth in this country gets created by people who own businesses, who own real estate, who own assets that actually produce value. See, dividend investing can work, but not the way they're selling it to you. The secret isn't chasing high yields, it's understanding that dividends are just one part of total return. And more importantly, it's recognizing that the whole system is designed to transfer wealth from people like you to people like me. The house always wins, unless you understand the rules of the game. Let me break down what actually works. First, you need to understand that a high dividend yield is often a warning sign, not a good thing. When a stock is yielding significantly more than the market average, it usually means one of two things. Either the company is in trouble and the market is pricing in a dividend cut, or the company is literally mortgaging its future to pay current shareholders. I learned this lesson the hard way back in 2008. I had clients loaded up on financial stocks because they were yielding 5, 6, 7%. Looked great on paper. Then Lehman Brothers collapsed, and suddenly those safe dividend stocks were worthless. The banks that survived cut their dividends to preserve cash. My clients got crushed twice, first on the stock price, then on the income they were counting on. The companies that actually build lasting wealth are the ones that grow their dividends consistently over time, even if the current yield looks modest. Think about a company like Microsoft. Their dividend yield might only be 0.7%, but they've been increasing that dividend for over a decade. More importantly, the stock price has gone up dramatically because the company keeps growing its business. But here's the thing that really gets me. The tax system is rigged against dividend investors too. Every time you receive a dividend, you owe taxes on it that year. You can't defer those taxes like you can with capital gains, so the government immediately takes their cut of your income. Meanwhile, some billionaire can borrow against his stock holdings, never sell anything, never pay taxes, and live like a king. The system is designed to keep working people paying taxes while the ultra-wealthy find every loophole in the book. And don't even get me started on what they call tax-efficient dividend investing. They'll put you in these complex ETFs with the expense ratios and tracking errors, all so you can maybe save a few percentage points in taxes. Meanwhile, the fund company is collecting management fees every year whether the fund goes up or down. They're guaranteed to get rich. You're guaranteed to pay fees. You want to know what real tax efficiency looks like? It looks like owning assets that appreciate in value without throwing off taxable income every year. It looks like understanding that the tax code was written by rich people for rich people and learning to play by their rules instead of the rules they tell middle-class folks to follow. Now, I'm not saying dividend investing can't work, but you need to approach it with your eyes wide open. The companies worth owning for dividends are boring companies with boring business models that generate predictable cash flows year after year. Utilities that people need no matter what. Consumer staples that people buy in good times and bad times. Companies that have been paying and increasing dividends for 25 years or more. These are called dividend aristocrats, and there's a reason they've survived multiple recessions and market crashes. They're not sexy, they're not going to make you rich overnight, but they're run by management teams that understand the difference between creating real value and financial gimmicks. The key metric you want to look at is the payout ratio. What percentage of earnings the company pays out as dividends. If it's over 70%, that's a red flag. The company doesn't have much room to grow the dividend, and any hiccup in earnings could force a cut. You want companies paying out 40 to 50% of their earnings, leaving plenty of room to maintain payments during tough times and grow them during good times. But even more important than individual stock picking is understanding the broader context. We're living through the greatest wealth transfer in human history. The Federal Reserve has created trillions of dollars out of thin air and handed it to banks and large corporations. Meanwhile, working people are dealing with inflation, stagnant wages, and a cost of living that keeps going up. This is not an accident. This is policy. The people who run the financial system understand that inflation is a tax on anyone holding cash or fixed income investments. They're pushing everyone into riskier and riskier assets because there's nowhere else to go for yield. And when those assets inevitably crash, guess who's going to get bailed out? It won't be you. So when I talk about dividend investing, you bet I'm talking about more than just picking stocks. You need to understand your place in a system that's designed to extract wealth from the many and concentrate it in the hands of the few. The only way to win this game is to stop playing by their rules and start playing by the rules of the people who actually own things. That means diversification, but not the kind they teach in business school. Real diversification means owning different types of assets in different countries with different currencies. It means having some exposure to real estate, to commodities, to assets that hold their value when everything else is falling apart. For most people, that means ETFs, not individual stocks. I know it's not as exciting as picking the next Apple, but ETFs give you professional management, automatic diversification, and tax efficiency at a fraction of the cost of trying to build a portfolio yourself. Something like the Schwab US Dividend Equity ETF, ticker SCHD, gives you exposure to about 100 high-quality dividend-paying companies for an expense ratio of just 0.06%. That's $6 for every $10,000 you invest. Compare that to the fees your financial advisor is charging you, and you'll start to see why I'm not popular at cocktail parties anymore. Or if you want dividend growth instead of high current yield, look at the Vanguard Dividend Appreciation ETF, VIG. It focuses on companies that have been increasing their dividends consistently, which tends to be a good predictor of future performance. The yield is lower, around 1.9%, but the total returns have actually been higher over the past decade because those companies have been growing. Here's something interesting that nobody talks about. VIG has actually outperformed SCHD over the past 10 years, even though SCHD has a higher dividend yield. Why? Because dividend growth is more important than current yield. Companies that can consistently grow their payouts are usually companies that are growing their businesses, and that shows up in the stock price over time. But here's where I really want to blow your mind. The best dividend strategy might not involve traditional dividend stocks at all. Treasury bills are currently yielding over 4%, and that income is exempt from state and local taxes. You can build a ladder of T-bills with different maturity dates and create a predictable income stream with zero credit risk. I know, it sounds boring. But boring sometimes beats exciting when exciting means losing half your portfolio in the next market crash. And with the Shiller PE where it is, that crash is coming. Maybe not this year, maybe not next year, but it's coming. This is where covered calls come in, and this is a strategy that the financial media loves to oversimplify. You own a stock, you sell call options against it, you collect premium income. Sounds great, right? The S&P 500 covered call index has yielded almost 12% over the past year. But here's what they don't tell you. Covered calls cap your upside. If you sell a call option and the stock goes above your strike price, you have to sell your shares at that price. You miss out on any gains beyond that point. It's like selling insurance on your own portfolio. This can work in a sideways or slowly rising market, but in a strong bull market, you're leaving money on the table. And in a bear market, the option premium you collect won't be enough to offset your losses on the underlying stock. It's a strategy that looks good on paper but requires perfect timing and practice. For most people, covered call ETFs make more sense than trying to manage individual option positions. Let the professionals handle the complexity while you collect the income, but understand that you're trading potential upside for current income, and that trade-off doesn't always work in your favor. The bigger picture here is that we're in an environment where traditional investment wisdom doesn't apply anymore. The Federal Reserve has distorted every market with their money printing. Bond yields don't reflect real risk, stock prices don't reflect actual company values. Everything is propped up by artificial liquidity that could disappear overnight. In this environment, dividend investing becomes less about income and more about finding companies that can maintain their competitive positions regardless of what happens in the broader economy. You want companies with pricing power, companies that provide essential goods and services, companies that can pass inflation along to their customers. But even more than that, you want to understand that this entire system is unsustainable. We can't keep printing money forever. We can't keep borrowing from the future to pay for today's consumption. We can't keep pretending that financial engineering creates real wealth. When I was on Wall Street, we had a saying, bulls make money, bears make money, but pigs get slaughtered. Right now, there are a lot of pigs in this market. People who think they can time everything perfectly. People who think the party will never end. People who believe the propaganda that markets always go up in the long run. The truth is, markets go through cycles. And right now, we're at the end of one of the longest and most artificial cycles in history. The next decade is going to look very different from the last decade. The strategies that worked when money was free aren't going to work when money has a real cost again. That's why I'm focused on helping people build anti-fragile portfolios. Portfolios that can not just survive the next crash, but actually benefit from it. That means having cash when others are forced to sell. That means owning assets that throw off real income regardless of what the stock price does. That means understanding that volatility can be your friend if you know how to use it. And it means recognizing that the American dream, as sold to us by the financial industry, is largely a scam. They want you to put your money in their funds, pay their fees, and hope that compounding will make you rich over 30 or 40 years. Meanwhile, they're getting rich off your fees whether your investments go up or down. The real American dream is owning things that produce value. Owning businesses that solve real problems for real people. Owning real estate that provides shelter. Owning assets that can't be printed into existence by some bureaucrat at the Federal Reserve. But most people don't have the capital or knowledge to buy whole businesses or investment properties. So we work within the system as it exists, trying to minimize the ways it can harm us while maximizing the ways we can benefit from it. That's where a thoughtful dividend strategy fits in, not as a get rich quick scheme, but as one component of a broader approach to building real wealth. You want enough dividend paying stocks to provide some current income. You want enough growth exposure to participate in real economic expansion. You want enough safe assets to sleep at night when everything else is falling apart. For most people, that might look something like 60% in dividend focused ETFs, 30% in some combination of covered call strategies and REITs, and 10% in treasury bills or short term bonds. Not exciting, but potentially effective. The key is understanding that this is not a set it and forget it strategy. Markets change, economic conditions change, and your portfolio needs to adapt. When valuations are extreme like they are now, you might want to be more conservative. When opportunities present themselves during the next crash, you want to be ready to take advantage. And you want to be realistic about returns. Goldman Sachs is predicting 3% annual returns for the S&P 500 over the next decade. That's before inflation, before taxes, before fees. In real terms, you might be looking at flat to negative returns for buy and hold investors. This is not a bug in the system, it's a feature. The people who run the system benefit from high asset prices because they own most of the assets. They benefit from low interest rates because they can borrow cheaply to buy more assets. They benefit from inflation because it reduces the real value of their debts while increasing the nominal value of their holdings. The only way regular people can compete in this environment is by understanding the game and playing it strategically. That means being selective about what you own, being tactical about when you buy and sell, and being realistic about what kind of returns you can actually achieve. It also means recognizing that to gain financial independence, you can't just have enough money to retire. You need to have enough money to say no. No to jobs that exploit you, to investments that don't make sense, to a system that treats you as nothing more than a source of fees and taxes. When I left Wall Street, I had colleagues who thought I was crazy. Why would I give up a seven-figure income to start a newsletter? Because I realized that helping people understand these concepts is more valuable than making rich people richer. Because I believe that an informed public is the only thing standing between us and complete financial feudalism. The dividend investing strategies I'm talking about today aren't going to make you the next Warren Buffett, but they might help you maintain your purchasing power while the Federal Reserve destroys the currency. They might provide enough income to give you choices in how you spend your time. They might be the difference between depending on Social Security and having real financial security. But the most important thing is understanding that this is bigger than just investment strategy. This is about recognizing that the current economic system is designed to concentrate wealth and power in the hands of a few people while everyone else fights over the scraps. The only way to change that is for regular people to start thinking like owners instead of workers, to start understanding how money really works instead of just accepting what they're told, to build real wealth instead of just chasing returns, and maybe, just maybe, to start questioning whether a system that requires infinite growth on a finite planet is really sustainable in the long run. Whether an economy that treats human beings and natural resources as nothing more than inputs to be optimized is really the best we can do. You don't have to become a revolutionary, but an owner. Own assets that produce income, businesses that solve problems, real estate that provides shelter. Own your own time and attention instead of selling them to the highest bidder. The dividend stocks and ETFs we've talked about today are just tools. The real goal is financial independence, and the real purpose of financial independence is freedom. Freedom to make choices based on your values instead of your financial needs, to say no to things that don't serve you, and freedom to build something better for the next generation. That's what this is really about. It's more than building a retirement portfolio. You're building a life worth living. Think of it not as accumulating assets, but accumulating autonomy. Instead of stumbling through your designated lane in the system, understand it well enough to use it for your own purposes. The clock is ticking on this current system. The debt loads are unsustainable, the inequality is extreme, and the environmental costs are mounting. Something's got to give, and when it does, you want to be positioned for what comes next. That might mean owning assets that hold their value when everything else collapses, or that having skills that are valuable regardless of what the stock market does. What it definitely means is understanding that the financial services industry is not your friend and their interests are not aligned with yours. So build your dividend portfolio, but build it with your eyes open. Use their tools, but understand their limitations. Play their game, but remember that the house always has an edge. And never forget that the real wealth in this world comes from creating value, not from financial manipulation. That's all I've got for you today. If this resonates with you, share it with someone who needs to hear it. If it pisses you off, that's probably because it's hitting too close to home. Either way, keep asking questions, keep learning, and keep building. Until next time, this is Rick Sullivan, reminding you that the best investment you can make is in your own understanding. Take care of yourselves out there.